Okay. Overview for today. First of all, we'll go through the changes, ATO activity in the cash economy crackdown, and also ATO, the current data matching activities. Exciting FBT, Fringe Benefits Tax, and then Brett will continue with super changes, ASIC and accountants licensing, lump sum pensions and payments. Okay, changes. It's been a reasonably quiet start to the year, with Parliament only resuming on the 7th of February 2017 and adjourning again on the 31st of March. They did manage to squeeze in through the Senate late on the final day the Enterprise Tax Plan Bill. Of course, the bill still needs to return to the House of Reps for consideration of an agreement to the Senate's amendments before they can become law. As mentioned, Parliament has now adjourned until budget sittings on the 9th of May, but the Tax Office has informed the Treasurer that it was not necessary for the House of Reps to remain and agree to the amendments in order for it to implement the company tax rate changes determined by the Senate. The effect of the government's amendments is that instead of applying to all businesses, the reduced corporate tax rate of 27.5% will only apply to businesses with an aggregated turnover of less than $50 million from the 2019 financial year onwards. Aggregated turnover is that of the company plus that of any entities connected or affiliated with the company. For the current financial year, the reduced corporate tax rate of 27.5% will apply for businesses with an aggregated turnover of less than $10 million, $25 million turnover in 2018, and a $50 million turnover in the 2019 financial years. So this effectively implements the first 3 years of the government's 10-year plan for company tax cuts. As per the trajectory in the budget, the corporate tax rate will also be further reduced in stages, starting from 1 July 2024, so that it will eventually fall to 25% by the 2027 financial year. In addition to the reduced company tax rate, the Enterprise Tax Plan Bill, as passed, includes measures to increase the small business entity turnover to $10 million from 1 July 2016, increase the unincorporated small business tax discount from 5% to 10% over a 10-year period, and enable small businesses with an aggregated turnover of less than $10 million to access most of the small business tax concessions. Fuel tax credit rates have also increased. So these are increased for fuel acquired from the 1st of February 2017. And the rates are indexed twice a year in February and August in line with CPI. The ATO says that businesses should check the rates or use the ATO's fuel tax credit calculator to make sure they claim the correct amount. Backpacker tax. So on the 1st of January 2017, tax rates changed for working holiday makers who are in Australia on a 417 or a 462 visa. So what does this mean for you? If you employ a working holiday maker on a 417 or 462 visa, you must register with the ATO so you can withhold the correct amount of tax. You should withhold 15% from every dollar earned up to $37,000 for foreign resident tax rates applying from $37,001. If you don't register, you need to withhold at the foreign resident tax rate of 32.5% from the first dollar earned. If you employed a working holiday maker before and after 1 January 2017, you need to issue 2 payment summaries for this financial year. So one for the income earned up to 31st of January 2016 and one for income earned from 1 January 2017. Okay, ATO activity, the cash economy crackdown. So the ATO is or has visited more than 400 businesses across Perth and Canberra as part of a campaign to help small businesses stay on top of their tax affairs. The ATO has a focus on businesses operating in cash and hidden economy to ensure fairness for all businesses and the community. The ATO has its focus on the following industries to make sure their registration details are up to date: hair and beauty, building and construction, restaurant, cafe, and takeaway and catering. So these industries are on the radar because they have a ready access to cash, which is a major risk indicator. The industries the ATO is visiting have some of the highest rates of concerns reported to the ATO from across the country. The visits are part of an ongoing ATO program of work, which is making its way around the country, and so far the ATO has met businesses in Sydney, Adelaide, Melbourne, and the Gold Coast. So the ATO notes that while paying wages in cash is legal and may be more convenient, some businesses deliberately use cash transactions to avoid meeting their tax and employee responsibilities. If people receive cash in hand, the ATO says they need to be paid at least the correct award wages, ensure they don't end up with a large tax bill because their employer hasn't taken tax out of their pay, get the benefit of super contributions, and be covered by their employer's work compensation in case of an accident. Data matching activities. Okay. So the ATO has been conducting data matching activities for many years now. The data matching program has been developed to address compliance risk of the registration, lodgement and reporting requirements of Australian businesses. The ATO has recently reminded tax professionals that it is collecting data on the total credit and debit card payments received by businesses, information on sellers using online selling platforms who sold at least $12,000 worth of goods or services, and details of payments made to ride sourcing drivers from accounts held by the ride sourcing facilitator. FBT, Fringe Benefits Tax. Okay. So the 31st of March marked the end of the 2017 Fringe Benefits Tax year. If you're an employer that has provided any non-salary benefits to employees, you may have an obligation to prepare and lodge an FBT return with the ATO. So types of fringe benefits which may be provided to employees are car fringe benefits, car parking fringe benefits, entertainment fringe benefits, expense payment fringe benefits, housing fringe benefits, living away from home allowance fringe benefits, property fringe benefits, board fringe benefits, debt waiver fringe benefits, loan fringe benefits, and residual fringe benefits. So the next few slides I'll go through will cover the most common fringe benefits provided to employees, with some additional information on each type of benefit. So firstly, car fringe benefits. A car fringe benefit generally arises when an employer's car is used by an employee for private purposes, including home to work travel, or is available to be used for private purposes. This includes being garaged at the employee's home. The following vehicles are cars. So motor vehicles, station wagons, panel vans and utilities, excluding panel vans and utilities designed to carry a load of 1 tonne or more. All other goods carrying vehicles designed to carry less than 1 tonne, and all other passenger carrying vehicles designed to carry fewer than 9 occupants. Car fringe benefits may be calculated in 2 ways, using either the statutory formula method or the operating cost method. You may elect to use either method for any or all of your cars, regardless of which method you'd used in the previous year. Oh, geez, sorry. Entertainment fringe benefits. Okay, an entertainment fringe benefit generally arises where an employer provides entertainment by way of food, drink, or recreation. It also includes accommodation and travel in connection with or to facilitate the provision of the entertainment. The provision of entertainment may give rise to a number of different types of fringe benefits depending on the circumstances under which the employer provides the entertainment. Different types of fringe benefits that may arise are a meal entertainment fringe benefit, where fringe benefits are provided by way of or in connection with food or drink. An expense payment fringe benefit, for example, movie tickets purchased by the employer and reimbursed. A property fringe benefit, for example, providing food and drink. A residual fringe benefit, for example, providing accommodation or transport. Okay, expense payment fringe benefit. They may arise in either of the following 2 ways, where an employer reimburses an employee for expenses they incur, and where an employer pays a third party for expenses incurred by the employee. In any case, the expenses may be the business expenses or private expenses, or a combination of the two. The taxable value of the business expenses will be reduced under the otherwise deductible rule. This means that the taxable value of the benefit may be reduced by the amount that an employee would be able to claim as a tax deduction in their personal return if the benefit was not paid by the employer. Living away from home allowance. Okay, so this involves the provision of an allowance paid to an employee to compensate for additional expenses or disadvantages because employees are required to live away from their usual place of residence in order to perform duties for their employer. Generally, employees in the following kinds of situations would be regarded as living away from their usual place of residence. So these include construction workers living in camps, barracks or huts, oil industry employees living offshore oil rigs, marine industry employees living on board vessels, training employees, for example, teachers, in order to undergo training courses of extended duration. Note that living away from home allowance differs from travel allowances paid, which form part of the employee's assessable income and are not fringe benefits. Access to the concessional fringe benefits tax treatment is subject to the following. So employees are required to maintain a home in Australia for their immediate use and enjoyment while they are living away from home. And the concessional FBT treatment will cease to apply once the employee has been living away from home in one location for more than 12 months. The reduction in taxable value is limited to expenses that can be appropriately substantiated, and there's strict declaration and documentation requirements. Finally, property fringe benefits. So a property fringe benefit arises where the employer provides an employee with free or discounted property. So these include, but are not limited to, goods including gas and electricity, real properties such as land and buildings, rights to property such as shares or bonds, and other non-cash awards such as vouchers. So what do you need to do? So review your benefits paid or provided to employees during the year ended 31st of March 2017. If you have provided a fringe benefit or you're unsure, we recommend you contact your accountant at Vincent's to discuss your obligations and to determine whether you will be required to lodge an FBT return with the ATO. You can obtain an odometer reading at 31 March for any vehicles used by employees for private purposes for any car fringe benefits provided. And depending on the fringe benefits provided, you may be required to complete a signed declaration from your employees. The ATO approved FBT declaration can be found on their website. And that's it for me. So I will now pass you on to Brett, who will finish with all the super update. Thank you.
Good afternoon, and thanks for that, Ben. Essentially, there hasn't really been a lot of movement in the superannuation space over the past few months. Obviously, before Christmas, we had the massive change in relation to essentially the concept of superannuation for retirement savings. So basically, I'm calling these the big ticket items. So the transfer balance cap, that being changed, so now you're not allowed to have any more than 1.6 million inside pension phase. Changes to both concessional and non-concessional contribution caps from 1 July 2017 onwards. So just at a very high level, the concessional contributions are dropping to 25,000 regardless of age, and the non-concessional contributions are dropping to 100,000, whereas prior to 30 June, it's $180,000. Importantly, the bring forward provision still applies, so the 3 years you can bring those forward into 1 year, providing you meet certain criteria. It's also worthwhile noting that with the non-concessional contribution caps now, you will actually be prohibited from contributing into super if you already have more than 1.6 million inside a super, regardless if you're in pension phase or not. So there's a few different stings in the tail in relation to the contribution caps. Changes to transitional retirement income streams from 1 July 2017, whereas the superannuation fund itself does not obtain a tax deduction essentially for providing that type of pension. So under the new rules, a transition to retirement income stream is no longer actually a pension. It falls outside the exemption. And the reason for that is because you still have, you haven't actually met a condition of release. So for your superannuation fund or your client's superannuation fund to obtain that tax exempt status on the income, it actually needs to be paying a type of pension other than a transition to retirement income stream. And then finally, as far as the big ticket items go, is the transitional CGT measures. Now, this is a very complex area and one that really depends on the structure of the fund, not only at 30 June, but also what's happened during the year. For argument's sake, what's called a segregated fund, which is one that's 100% pension, may be in place at 1 July 2016. However, during the course of the year, if contributions have been made, then in theory it falls into another type, being the proportional method. And that can actually have very different tax consequences if you're electing to use these CGT measures. So it's a real trap that needs to be watched, and it's going to require a lot of communication prior to preparing the 2017 tax return for self-managed funds between advisors, trustees, and the accountants, because essentially all three will have a say and have a play in how that's formulated and what that actually means. So that's a real big issue, I suppose. Now, if you want to understand more about these big changes that are coming, essentially they are the biggest changes we've had inside super in the past 10 years. We have done previous webinars on those, and there's a link that you can see below there that actually relates to those. So you can actually watch some previous webinars that we have provided. Alternatively, we are adopting a process of discussing these changes with clients that are actually affected, but by all means, feel free to contact myself or anyone else in the Superannuation advisory team to talk about how these changes will impact and affect you. Now, in relation to these changes, the tax office are actually adopting a process whereby they prepare companion guides on how the laws will actually be applied or how they're impacted. So they're called law companion guides, funnily enough. So basically, it's the ATO's view on recently enabled or enacted laws. There's something they've only just recently started to do, and I suppose specifically the superannuation world has pretty much consumed the whole notion behind these type of documents. And it's great that the tax office are doing them. It's just a shame that due to the timing constraints that they haven't really come out sooner than what they have. Bearing in mind that the legislation was only passed essentially mid-November last year, the tax office have been releasing these guides in draft form and then in final form. And to date, we have 4 of the 6 released in final form, and there's still a couple more to go in that are still in draft. So basically, these are all available on the tax office's website. If you want to have a read of them, they try and make them relatively user-friendly with lots of examples. So they're well worth the read, particularly if you can't get to sleep one night. Fantastic to help that. So just quickly running through the ones that they have actually finalised. So 2006-8, which is the superannuation reform in relation to the transfer balance cap and the transition to retirement reforms. So also encompassing the capital gains tax relief measures, more specifically. The transfer balance cap, so if you have played along with the new superannuation lingo or bingo that's been going on in relation to all these new acronyms we have, the transfer balance cap is basically what your balance is that you can have inside a pension account. Number 10 looks at the superannuation reforms relating to defined benefit income streams. So think of your Commonwealth Superannuation Scheme pensions, Q-Super defined benefit pensions, things like that. So of some limited relevance, I suppose, to most people, particularly in the self-managed super fund space. Number 11 looks at concessional contributions and essentially how they're defining those, and also in relation to constitutionally protected funds. So rather than where the SGC or the superannuation guarantee is paid on the 9.5%, it's based on a formula, so how that actually works. And that one was only released or finalised 2 days ago, so that's one's hot off the press. And number 12 looks at the total superannuation balance. So essentially how an individual's member balance is determined as part of all these reform measures. Now, remembering that it's not as clear cut as what you may think, that your balance is either increased or decreased depending on the type of pension you have, depending on your personal circumstances, how your money got into super, things like that. So that there is a fair bit of discussion or work that needs to be done, even just around a relatively simple concept such as that. One still to be finalised, defined benefit income streams that are non-commutable. And also on transfer balance cap on death. So I'm actually going to be talking just a little bit about how that works, because it's something that is obviously relevant, but only if you die after 1 July 17. Something that was initially proposed in the changes that came through in November last year was the non-requirement, if you like, to have actuarial certificates going forward. So this caused a little bit of a ruckus in the industry, obviously particularly in relation to actuaries, because they produce a number of these type of certificates that say, yes, you have a tax exemption for having a pension paid by a super fund. So originally it was proposed that the super fund would not have to obtain a certificate. However, they've released the regulations around this measure, and they have actually dropped that out. So that one's fallen away. So essentially meaning that it's a status quo. In other words, you still need to obtain a certificate if you want to use the proportional method to claim a exemption. However, what this has actually meant is it's now created a bit of a technical issue that the tax office are well aware of, and they are working through as to how they can fix it. Because essentially the way that the legislation works is that if a member has more than 1.6 million in total superannuation of a total superannuation balance, so not only in the self-managed fund but in any other superannuation fund, and they're receiving a pension, then the fund is actually prohibited from using the segregated method. The purpose behind this was around perceived manipulation of capital gains tax events to make sure that a better deduction is obtained. Now, by putting this prohibition into the legislation, it now means that if you have a situation where a member starts a pension on 1.6 million, sorry, 1.5 million in this case, and then that grows to, say, 1.65 by 30 June 2018, when preparing the 2019 tax return, the accountant actually needs to obtain an actuarial certificate because the member's balance is greater than 1.6. However, the certificate's still going to be 100% exempt because the pension was started on an amount less than 1.6. It has grown just through normal investment earnings. So now the balance is more than 1.6, but that 1.6 is actually hard-coded in the legislation. So we've got a bit of a disconnect, if you like. So where they've tried to say you don't need to, and this is why they've tried to exclude actuarial certificates from being obtained. But now that exclusion's been dropped, we've now got this situation where you have to obtain a certificate even though it's going to be 100% exempt. So that's not something that's going to impact us before 30 June, but certainly as we roll through, it's just something to watch. Because if you have a fund that is exactly 1.6 million, then it may need to actually, 1.6 million per member as at 30 June 16. It may be that 30 June 17, it may be we actually need to obtain an actuarial certificate when we would not otherwise have needed to. So that one's just a bit of a quirky one. And the government, unfortunately, isn't done on the changes for superannuation yet. So by that, they've the Minister for superannuation or for finance, Kelly O'Dwyer, came out just recently and said they're looking to make some minor and technical changes to the superannuation legislation that's been passed. And this is in relation to where a fund has a limited recourse borrowing arrangement, and they want to basically manipulate the total superannuation balance and the total superannuation cap where that's the case. So amendments that will be made, basically looking at a total superannuation balance will count towards the outstanding balance of the LRBA each year, and then the repayment of that will actually be a credit towards your total total balance cap. So basically they're adding it on and then they're taking it back each year. So that one is, to be quite honest, an absolute nightmare, because what happens if you have 4 members inside the fund? How do you actually allocate who is to obtain that that proportion of that loan for the member? So that one's still some work in progress, if you like. I have heard that Treasury are trying to talk the minister around and not putting that forward. So hopefully that's the case. Now, I've actually just got a question here in relation to foreign source pensions and if they'll have any impact on the total balance cap. Look, essentially, if what you're receiving is actually a foreign pension, so that's income, so that won't have any effect on the total balance cap. However, if that money was transferred to Australia, then it does fall under these new regimes because it comes part of the member's balance inside the Australian Superannuation Fund. So sourced income is just that, it's income. These measures only relate to Australian resident complying superannuation funds. So hopefully that answers your question, Tim. Now, one thing that I mentioned before, the Law Companion Guide is coming out in relation to how death on members is treated. But as a bit of a précis, a bit of a high level as to how it's actually going to look and what it's going to mean. So basically, on death, there's 2 possible treatments for dealing with the death benefit. Remembering that what they're trying to do here is have the deceased balance, superannuation balance, leave the system. They really want to remove the estate planning implications of superannuation. So what they're doing is trying to arbitrarily force that arrangement. However, there are ways in which we can work around that, essentially, if that's the member's intention or the surviving spouse's intention. So if, and we've got different treatments depending if we have accumulation or a pension being paid where there is no reversionary pension. So a reversionary pension is where where the deceased pension automatically reverts to a spouse, and that's basically in the original pension documentation that's prepared, allowed by the trust and allowed by the trust deed. And also if there is a pension with a reversionary nomination in place. So basically, in the first situation, the transfer balance account is made up of the deceased balance at the time, at the time of the transfer. So let's say, for argument's sake, that someone, and I've got an example that I'll work through in a minute, but if someone dies, if that's not dealt with for 5 years, then basically it's the balance in 5 years' time. That's what is actually treated towards your transfer balance account. Where we have a reversionary nomination in place, the surviving spouse has 12 months to actually take effect of that transfer. So it has to happen within 12 months. If it doesn't, then it automatically occurs, and then that can create all sorts of problems around their transfer balance cap. So it's important that if there are reversionary pensions in place, that the trustees understand that they will only have 12 months to deal with it. So as an example, say we have Alison who dies on 31 December 2017, and she has a pension balance of 1.4 million. Now, remembering it doesn't matter if it's reversionary or not at this stage. Her husband, Shane, he has a balance of $1 million. So in order to retain all of that balance inside super, Shane would need to stop his pension and commute it back to accumulation, or at the very least, he would need to do $800,000 of his $1 million pension. and then commence a pension on Alison's death benefit. So if that's a reversionary pension, that has to happen within 12 months. And it will be at the time the transfer balance account amount is at the time of death. If it was not a reversionary pension, then the transfer balance account is basically the amount of the transfer that occurs at that time, and that can be however long. So if that's 4 years' time, then it's the amount that it's worth in 4 years' time. So if presumably markets go up, I say on average 5 to 8% every year, so that means that you're dealing with essentially a bigger problem the further along the line you go. Now, just quickly dealing with ASIC and the accountant's licensing. Now, ASIC have been making a few announcements of late and putting a bit of noise around about how they're going to be instigating some shadow shopping. So what that means is they will essentially pretend to be a client and be coming in and asking about superannuation or self-managed super funds specifically, and particularly focusing on the establishment of them. So you may recall that if you're an accountant, unless you're licensed, you can no longer provide advice or advise clients to establish a self-managed super fund. If you are licensed, then there should be a statement of advice that's prepared for that. Late last year, ASIC did release an information sheet, 216 on their website, so that link will take you directly to that. However, it doesn't really provide a lot of guidance to what the day-to-day administration of a super fund means and the implications thereof. So for argument's sake, starting a pension, it doesn't specifically talk about that arrangement. However, if you advise a client to start a pension or to stop a pension, then that actually means that you are providing advice in relation to a superannuation product. So that means that a statement of advice needs to be prepared. So think about all these changes that we're going through, where if a client has more than 1.6 million inside super, then in pension phase, they might have to commute some of their current pension account back to accumulation. So that means that you're actually providing advice to them to do that, if that's what you're doing. Same with the CGT arrangements. You actually need to be licensed to provide taxation advice to allow you to do that in refreshing of cost bases and the like. So there's a fair bit involved with all these new super changes, and I suppose the important thing here is that this isn't an optional extra basically for accountants to do. We have to provide advice in relation to these measures where we're advising clients what to do. So for argument's sake, I'm having lots of discussions with our clients in relation to the superannuation changes, all just general factual information about what it's going to mean. Then when we actually come to implement what needs to happen, we're either going to have to ask or provide the client with a statement of advice, or ask them to provide direction to us to say, this is what we want you to do. So unfortunately, that's just how the law works. And unless you're licensed, then you're going to have some challenges in actually handling that situation. And lump sums in relation to pension payments. So I mentioned before about the regulations that have recently been passed that excluded the actuarial requirements. As part of those regulations, they actually prohibited the ability to pay, or to treat, I should say, a pension payment as a lump sum for tax purposes after 1 July 2017. So currently, under Reg 995 1.03 of the Income Tax Assessment Regulations of 97, for those who want a bit of light reading, it does actually allow you to treat a pension payment, so whether it be a transition retirement income stream or an account-based pension, that would otherwise be treated as a pension for income tax purposes, it will allow us to treat it as a lump sum. Now, by passing of the regulation, or I should say the registering of the regulation, means that we can no longer do that from 1 July 17. There's something just to also bear in mind is the Tax Office has recently issued a couple of private binding rulings in relation to this. And that states that the super fund's exemption for pension income reduces to the extent for the election that's been made. So in other words, you don't get the tax deduction for paying a pension if you're using the lump sum method. Now, these are private binding rulings, so they're not applicable to everyone. However, they are guidance and they should be looked at and considered as part of your preparation of the 2016 and 17 tax returns if the client is specifically looking for that deduction inside the super fund. And then you'll need to weigh that up in context to what that means from a tax outcome for the individual. Because obviously, if it's treated as a lump sum, you're allowed to access the threshold of up to $195,000 tax-free, whereas as a pension, it's treated as normal taxable income essentially, less the tax offset of 15%. So there is some scenarios that should be run through to see, is it really worthwhile in doing that? A couple of other things that I should just briefly mention in relation to that regulation that was passed, that was registered, I should get my terminology right, that basically the automatic election or the automatic mechanism whereby if a non-concessional contribution is made to a super fund that breaches the fund cap rules, that currently it automatically needs to be rejected by the super fund. So if a member makes one contribution of $550,000, let's say, that needs to be automatically rejected under the current rules. Going forward, that actually won't be the case. So there is the ability for a super fund to receive will be say $310,000 non-concessional contribution, because the bring forward rule drops down from 180,000 currently down to 100,000. 3 times that is 300,000. So if the member puts in $310,000 in one go, the super fund can actually receive it. And then what happens is we have a mechanism whereby it's treated as an excessive contribution and dealt with that way. So there's a different mechanism that basically applies going forward from 1 July 17. So that's well worthwhile just remembering that that's going to be the case. And basically, that is the end of our quarterly update for tax and superannuation. So unless there are any other questions, it has been, I suppose, relatively quiet, as Ben said, in the tax area, and specifically in the super area. The industry has more been focusing on the changes that are coming very quickly that need to be implemented and discussions that need to be had before 30 June. So if there's no further questions, then we'll leave it at that. Don't forget that we will be doing our normal budget webinar the day after the federal budget in early May. So we look forward to you tuning in then. Otherwise, thanks very much for watching. Cheers. Bye-bye.